Here's a question. Is China in for a hard landing? I certainly hope not, because that would have profound global implications. Yet you can't help but be concerned that its property market, one of the foremost engines of its economic growth, may have overheated. Remember what happened to the U.S. version? There's one big difference, though. America's capitalist economic system is far more mature and sophisticated than China's, and is not as dependent on that market as China's economy is. Now, is China prepared for a housing market slowdown? Well, that we may find out down the road, though. But the cracks in the market have started to emerge, as reported by the China Daily. Industry groups say property sales in China fell by almost a third in major cities during the May Day holiday compared with the same period last year. And they're worried because the country's real estate business is cooling quicker than many people had expected. Second-tier cities, mostly provincial capitals, saw housing sales drop by about 35%. And the housing market in smaller cities has been sluggish since last year. Now, here's the question. Where's the problem, huh? Many reports have said the market is controlled by China's wealthy class. And to protect their investment, they've manipulated prices to keep them from falling. But you know what they say, all good things, if you can call it that, must come to an end. And because these prices have reached astronomical levels, many of these rich Chinese have decided to look elsewhere around the world to satisfy their financial gluttony. Ergo, what goes up must come down. And indeed it has at an alarming rate. And if mainland real estate developers hope to fill in that gap with potential foreign buyers, think again. Here's how the South China Morning Post saw it. Foreign activity in the mainland's real estate market has hit a 10-year low as risks rise while restrictions remain. During the double-digit % growth in China's economy in the past 3 decades, anyone investing in the real estate market made a fortune, regardless of what they bought and how much they knew. Data from China's statistics agency showed foreign investment remained below 1% of the real estate market after the global financial crisis. But even in its heyday, foreign participation had never exceeded 2% of total sources of funds into the sector. It's a sector which affects dozens of other industries in the world's second largest economy. See what I mean? That's how crucial China's property sector is. And the red flags are all over the place, as reflected in this Phoenix TV report. China's great real estate bust has begun. Well, that's according to Nomura Securities, a leading securities and investment banking company in Japan. It says a combination of a huge oversupply of housing and a shortage of developer financing is producing a housing market downturn that could drive China's GDP to less than 6% this year. For some time, Nomura has been among the most bearish of the big investment houses when it comes to China. And it has made some gutsy calls, although they haven't always turned out to be right. In early April, for instance, Nomura forecast that China's current account, the widest measure of trade, would be in the red in the first quarter of this year. When the numbers came in recently, China still had a current account surplus. But at $7 billion, it was the smallest quarterly surplus in 3 years. So it remains to be seen whether Nomura this time will be Paul Revere warning of trouble ahead or Chicken Little warning of trouble that never seems to occur. Nomura bases a lot of its argument on the observation that property investment turned negative in 4 of China's 26 provinces in the first quarter of the year. To Nomura, that's a warning sign of similar problems to come in other Chinese provinces. It adds that falling investment leads to falling levels of construction and sales. And given the property market's huge role in the Chinese economy, a decline in the growth in the property sector means a drop in the GDP. Well, it may be water under the bridge at this point, but I think it's never too late for the Chinese government to intervene to prevent a small sector of Chinese society from controlling prices. However, at least one of China's more distinguished economists believes it's not as bad as others think. ChinaIRN.com reports on his take. Andy Xie said China's real estate bubble is starting to break, and property prices in 2014 will drop by 50%. But he added that China's real estate bubble is not the same as those of other countries. He said in China, the burden is transferred from real estate developers to the government. He admitted this would lead to bad debt, but that the government would take care of it. Well, China has certainly undergone tremendous challenges in its long history. This one is no less challenging.